All right, it's time now for Word of the Day. That's fun. We're bringing it back, where we break down a financial term or concept for our smart viewer, but just maybe not the financial expert. And today it is ETF, or Exchange-Traded Fund. Given this, exchange-traded funds are poised to overtake credit derivatives by year-end as a way to speculate on junk bonds. And there was also this from last week. Investors plowed more than $15 billion into ETFs in the past week, lifting assets to a record amid expectations that the Federal Reserve would launch a third round of quantitative easing. Now, by attracting those looking to invest in non-traditional assets and sectors, the global ETF market, look at that, it's inflated to more than $1 trillion in assets over the past few years, and some now actually put that number at about $2 trillion. Now, David Kotok, who's a guest of ours, wrote a book on ETFs, and he spoke about them on our show recently. Take a listen.
So the ETF has revolutionized the options for an investor. I can take $1 million and I can replicate a Yale University foundation account in the billions because of these instruments.
However, Kotok warns that investors should conduct serious research before purchasing shares in any ETF, and we will explain why shortly. But first, what exactly is an exchange-traded fund? Well, here is our definition. Let's take a look at that. ETFs are our portfolio or a basket of securities which provide diversification, kind of like mutual funds. Yet they're unique in that they trade on an exchange just like a common company stock. Now, they usually track an index, either holding the underlying stocks of the index or using derivatives to achieve the same returns as the index. And since an ETF is designed to track a specific market index, one can play an entire sector without being forced to stomach the volatility inherent in any one stock. Now, let me give you an example. Investors can gain exposure to precious metals using ETFs. Specifically, gold and gold miner ETFs have become increasingly popular. But why would anyone want to own shares in a gold ETF in the first place?
I don't have a problem if you want to buy gold, but if you're going to buy gold, don't buy the actual commodity, because you have to store it, you have to have it reassayed if you sell it. But buy an exchange-traded fund that invests in gold.
There you have it. Like Susie Orman says, buy an exchange-traded fund if you invest in gold. But if you buy shares in a gold ETF, like the GLD, for example, which is the largest gold ETF in the world, do you actually own gold? The answer is no. You're effectively buying shares in a fund indexed to the gold market. This is not the same thing as buying physical gold bullion and storing it in allocated vaults, which is a key distinction. In fact, according to the ETF's own prospectus, the average investor can only redeem their gold shares for cash. Only those who have very large holdings in a fund like GLD have the option to redeem their shares for physical gold. This requires somewhere in the neighborhood of 100,000 shares, which translates into millions of dollars. And even then, it's a difficult process. Also, in the case of GLD, let's take a look at the prospectus, because the trust does not insure its gold, which means it may not have adequate sources of recovery if its gold is lost, damaged, stolen, or destroyed. And this may surprise you when reading the prospectus, as we have. The amount of gold represented by the shares will continue to be reduced during the life of the trust due to the sales of gold necessary to pay the trust expenses, irrespective of whether the trading price of the shares rises or falls in response to changes in the price of gold. Wait a minute. The so-called pot of gold shrinks? What kind of deal is that? And finally, one more look at the perspective, because gold held in the trust's unallocated gold account and any authorized participant's unallocated gold account will not be segregated from the custodian's assets. If the custodian becomes insolvent, its assets may not be adequate to satisfy a claim by the trust or any authorized participant. Now, that may sound confusing, but in basic English, sounds like if the custodian, in this case HSBC, runs into trouble, it may not be able to make good on your claim. So it would appear that the only way to protect yourself as an investor when it comes to ETFs is to do detailed research on the fund, its assets, and carefully read its prospectus. And even then, you're still dealing with the counterparty risk. Now, this is why some would argue that buying a gold liability, which is what a gold ETF is, defeats the purpose of owning gold in the first place, as precious metals are one of the few asset classes accessible to average investors that are not simultaneously another person's liability. And we've talked a lot about that in other episodes, but in any case, now you know about ETFs, and if you're interested, you know to get your reading glasses out and ready to dissect the fine print.